But also, we want to give you kind of a peek behind the curtain into what we see coming both in the economy and the markets, how that might impact you and your portfolios and what we do with those portfolios, and hopefully give you a couple of takeaways that you can feel good about as we look into the future. And with that, I always like to begin with a couple of different themes as we go through these sessions. And so our themes this time around are cautious optimism and perpetual optimism. So at times, those who have been with us a while, at times our job for you is to be your eternal optimist. And so that's certainly how we're going to finish, with some big picture reminders of why we are always so optimistic in the long run. But in the short run, we have, I'll say, some cautious optimism. And for those who follow the market at all, today was one of those, I suppose, reasons to be cautious. And while we still believe this is going to be a good year, in no way do we believe it's going to continue at the pace by which it started the year. So we have some cautious optimism in that way. All right, so we always start with our speedometers. And again, these are forward-looking economic and market indicators that we get from one of our investment partners, CNR, or City National Rockdale. They do a wonderful job with these. And for the first time in about a year and a half that we've been doing these, we have green on the page, other than, I suppose, our logo. And that's nice to be able to report. For a long time, there's been a lot of yellow and red. I've been promising that there is, in fact, a third color available on these indicators. And here this quarter, we see 7 green indicators, which is really awesome. And in addition to that, we had 3 more that moved in a positive direction. So if you can kind of see the gray indicator in the background, and then the black indicator, that sort of gives you directionally which way these have moved. And so you can see there are 3 that moved in a positive direction and 7 that went into the green. And that is all very good news. Now, there are a couple, housing and mortgages and inflation, that we think by the time we see you next quarter, will likely have ticked back into the yellow. Interest rates don't seem to be moving a whole lot, and inflation seems to be holding pretty flat. And so we think those are likely to tick back into the yellow. But still, for now, through the first quarter, we're in pretty good shape here. And very excited to report that we have 10 speedometers moving in a positive direction, 7 in the green. Now, there are still a couple that are in the red here. And these are not likely to move anytime soon. Now, equity market valuation might come down a bit, but geopolitical risk is certainly not going anywhere. The wars in Ukraine and the Middle East have only escalated here recently. So geopolitical risk is not going away anytime soon. Equity market valuation might improve over the next quarter. If it does, the good news is it'll be out of the red. The bad news is it's probably because prices come down significantly. But I'll talk more about that in a couple of minutes. But again, a lot of good data here, and by and large, this is good news. This is exciting news. So we're happy to report this. So a good start. And this is one of the reasons why we're still pretty optimistic. Moving on to stocks, the market in the first quarter did very well. S&P 500 was up 10% for the quarter. Mid cap was almost the same. Dow Jones, about half of that. Small cap kind of pulled up the rear at 2%. But what I'll note here is that over the last 3 years, the S&P 500, which tends to average about 10% per year, is back on track, at least on average, 32% over the last 3 years. Again, that's about 10% per year. We're not quite there on the 2-year yet, which makes sense given that 2022 is still going to pull down those numbers with the terrible year that we had 2 years ago. But we got off to a very, very strong first quarter. Now, if you extrapolate this, if you take 10% in the first quarter and say that happens every quarter this year, that means we'll be up 40% this year. We are not going to be up 40% this year. I can't promise or guarantee anything, but I can tell you with a high degree of confidence, we will not be up 40% this year. I would love to be wrong on that, but that is highly unlikely. We've already seen a pretty big pullback, and at least as of yesterday's close, we were up about 6% for the year through yesterday. So we've already seen something of a pullback these last 3 weeks. And I'm going to kind of make some references to that as we go. Normally, I'll focus on Q1 when we're talking about the first quarter. But there's been so much volatility here over the last couple of weeks that I do want to make some references as we go. So I suppose I beg your forgiveness as I'm going to kind of cheat into Q2 as we're talking about Q1. But Q1 data was very good. We have seen a little bit of a pullback. Again, we don't think that this year is going to be a 40% return year. We've been saying for months that we think this year is going to be pretty tepid, something like a 7 to 8% market return for the year. We do think it'll be a positive year, if for no other reason than it's an election year. And election years are notoriously bumpy, but also notoriously positive. We usually see a very strong finish to the year in November and December following the election. Cover that a little bit more as we get through this, but we do believe this will be a good year. We just don't think it's going to be anything like last year, or certainly not the way that the year started. And we're already now these last 3 weeks kind of seeing that. But it does tell you, if the market was up 10 and we're expecting 7 to 8, kind of tells you what we're in for the rest of this year. Probably pretty bumpy, and don't be surprised if that's what we see. All right, so I mentioned a couple slides back, equity market valuation is in the red. And sometimes we get questions like, well, how can this be? How can this be in the red? And yet you just told us that leading indexes have moved in a positive direction and the market's up 10%. And how can equity markets be valuation be in the red? And it goes back to the price of stocks. So right now, the price of stocks is relatively high as a measure of their earnings. So PE ratio, as a quick reminder, simply measures price divided by earnings, right? That's PE, price to earnings ratio, meaning that stocks have companies have earnings, I hope. Right. So and they'll usually distribute those in the form of dividends, or they'll reinvest in the business or whatever it is. But companies have earnings. When companies have earnings, and we relate that then to the price of the stock, it gives us a PE ratio. So the average PE ratio over the last 30 years is about 16. So in general, stocks will trade on average 16 times their earnings. When stocks get more than one standard deviation away from the average, which is about 20 times earnings, we start to feel like stocks are a bit overpriced. And certainly that's where we're at right now. We're about 21 times earnings. We're more than one standard deviation away, which is telling us that stocks are a bit expensive. Now, that does not mean that we run for the hills. We don't know necessarily what's going to happen, because there's two ways for PE ratio to get back towards its norm, right? One way is that stock prices come down, right? So the market declines. The other way is that earnings come up. And first quarter earnings were actually very, very strong. And we kind of expected, as we were getting into this data, that we might see prices or the PE ratio be closer to average. But that didn't happen because while earnings were very, very strong in the first quarter generally, the market outran them. And so the economic data through Q4 and Q1 was so strong that, combined with expectations on interest rates and with positive earnings, sort of sent the market into a bit of a frenzy. And so we saw a huge expansion on stock prices in the first quarter, faster than earnings could keep up. So we think it's likely to end up being somewhere in the middle. Prices will likely come back down. Earnings hopefully will continue to be strong, although some of the tech sector earnings here over the last week, as they're starting to come out, are a little bit, some of them have been a little bit weaker than expected, but we're hopeful that earnings will continue to be strong and prices will come back a little bit, and we'll get it back into more of an affordable stock price. One note here, and I will not bore you with all these statistics if for no other reason than I'd like you to stay awake for the next 40 minutes. But by every measure, every statistical measure of stock prices, they are all more than one standard deviation away from their long-term averages, telling us that stocks are expensive right now. So again, a little bit of why we don't think over this next year that we're likely to see this mass return like we had last year. It's much more tepid. And you can see here 1 year returns, subsequent 1 year returns when looking at PE. As we get out here into the 20s, you don't see a lot of, return in here. Now, it's not impossible. There are positive returns at times with higher PE. More times than not, though, it's not terribly positive. And so we're expecting a very tepid return over this next year. Again, something in that, probably in that 7 to 8% range would be our expectation. Not expecting a negative year. And why not? Again, because it's an election year, and it is very rare for election years to be negative. It's not impossible. It's just rare. So that's where we find ourselves today. Higher PEs and thereby less opportunity for return over time, at least over the next year. Through this slide in here, just as kind of a reminder, that the top 10 stocks in the S&P 500 right now are making up about a third of the overall weight of the index. So those 10 stocks are having a giant influence on which way the market goes, right? And that is likely to continue. Those top 10, it's very tiny print, but they're down here at the bottom. It's Microsoft and Apple, NVIDIA, Amazon, Facebook, Google. I'd say all your usual suspects. And those stocks are, particularly the tech industry, kind of pulling the market in one direction or the other. And it is in large part, by the way, why we've seen so much volatility here over the last week to 10 days. Some of those tech stocks have come in a little bit weaker than expected. NVIDIA, Tesla in particular, Meta, Facebook yesterday, all a little bit on the weak side. And so we're seeing some higher volatility and a little bit of a pullback here. But those stocks aren't really the problem, actually. Those stocks tend to have a higher PE anyway. What's really driving our concern on pricing is what's going on with the other 490 stocks in the S&P 500. Those are also trading well above the long-term averages on PE. So again, not trying to encourage anyone to run for the hills, but setting expectations, and why, while we're optimistic about this year, we're cautiously optimistic as we look ahead into the end of the year next year. All right, volatility is normal. I show this slide every time. I will show this slide every time. This is my quarterly reminder that stock prices go up and down, and every year they go down. In fact, this one goes back to 1980. If I went back to 1930, it wouldn't make any difference. In every single year, there will be a point in time where the market goes down. And we just have to kind of sit through it to get the long-term averages that we see. And I'm going to touch on this a lot more later. Where we have to sit through those downturns. We have to be patient and recognize that they happen every single year. Volatility is normal. In fact, already this year with the market up 10%, we've had a point in time where it was down 2% just in the first quarter. Do not be surprised this year if we see the market down 10 to even 15% somewhere this year. As I've been saying, election years are notoriously choppy, and we're dealing with a number of other factors right now. We're coming off of a very strong year last year. Interest rates are not going to move. Yes, I'm still talking about interest rates. Interest rates are not going to move like they were anticipated to move coming into this year, at least by investors as a whole. And so we are going to see some really volatile times, and we haven't even really gotten into election season yet. So don't be surprised at all if we see a 10 to 15% pullback in the market. In fact, just as a point, if I averaged out all these red dots on the bottom here, the average pullback in the average year is 10%. So do not be surprised if we wind up in correction land somewhere this year. But we still think that as we get to the end of the year and the election comes and goes and the market has a little bit more certainty about who's been elected, that we'll see a bit of a rally towards the end and should end up in positive territory. So don't be surprised if and when that happens. All right, so let's talk about the economy a little bit. Long-term trend on GDP, gross domestic product, a measure of how the economy is expanding. Long-term average is about 2%. Quarter over quarter, in the third quarter of last year, we thought that was going to come in around 4. It came in at almost 5. Because these numbers are always trailing. So we're just now getting some indication on how Q1 was, and I'll touch on that. But quarter over quarter was 4.9. Quarter over quarter here was 3.4. We thought it was going to come in at about 2.5. If you were with us last quarter, you'll remember that. It looks like quarter over quarter we might see 2.5 again this time. But after today's information, maybe not so much. If you had joined us on Tuesday, I would have said 2.5, and I hope they prove us wrong. It looks like GDP growth year over year is going to come in somewhere around 1.5 to 2. Which means quarter over quarter is more likely to be closer to 2% than 2.5. So it looks like GDP is starting to slow. Now, that isn't necessarily bad. It's still positive and it's still near the long-term trend. But the economy is slowing a bit, and that's going to be a theme of mine as we go through this. Again, not terribly concerned about 2024. We think it's going to be a good year, but what's going to happen in 2025 is what has us on the cautious side. The other thing that we look at on this slide, for those who have been with us before, is government spending. And again, this is not a commentary on whether or not government spending is good or bad. I make no political statement there. Simply, we want to track it as a percentage of GDP, because as a percentage of government spending goes up, we tend to see more inflationary pressure. And this number has stayed very, very flat. We've been right at 17% for the last year plus. Yes, government spending has been going up, but so too has GDP. And so as a percentage of GDP, government spending has stayed pretty flat over the last year or so. That's good news and a good sign, again, as we think about inflation. A number of other things that are good. Business fixed investment is up. So businesses are investing, particularly back into themselves. Inventory and sales ratios are up. This is good relative to supply and demand. It means there's a little less pressure on the supply side, again, relative to inflation. So that's good news. Light vehicle sales are up. So consumers are spending. That's good news. Residential real estate is down. I'm going to talk about that in a minute. But all in all, some really positive signs here. So if I keep just giving us positive news, why do we have so much caution? And here's one of the reasons why. And there's a couple points to this, but I'm going to stick on this one for a minute. Delinquencies, 30-day delinquencies, meaning people who are more than 30 days late paying their auto loans, credit cards, and student loans. Now, we haven't seen much in the way of student loans, but it was just in October that student loans went back into repayment. So we weren't expecting to see a whole lot of movement there. But in auto loans and credit cards, we are now seeing late pays higher than their long-term averages, certainly over the last decade. A number of reasons this could be the case. One, unemployment data is kind of hiding some information. Unemployment still is very low. I'm going to show you that in a second. But this could be telling us that unemployment is higher than the data is suggesting. I don't think that's the case, but that's what it could mean. It could mean underemployment is an issue, meaning people are employed, but they're not earning enough to maintain lifestyle, right? So underemployment may be an issue. Inflation might be the cause, or at least in part a cause. Why? Because if inflation is chewing up more of our day-to-day spending, if the cost of food and goods is using up more of my money today, then I don't have enough money to pay for yesterday. And that's what we're looking at here. We're looking at yesterday, credit cards and auto loans. And so if inflation is eating up today's dollars, I might not have as much money available for yesterday's payments. So that could be the issue. The other thing, and we think this is probably the biggest reason we're seeing this data, but it doesn't make it any less scary, is that one of the economists we follow likes to talk about the COVID years as a sugar high relative to cash. And what they mean by that is we found ourselves for about 2 years in a position where we weren't able to spend the way we normally spend because we couldn't go anywhere, in part. And because we couldn't go anywhere, across the US, savings went through the roof. Household savings was the highest it's been in decades through COVID. In addition to that, there were COVID dollars being pushed into the economy. And again, no commentary on whether or not that was a good thing or bad thing. It's just reality. And so we saw dollars getting pushed into the economy, into the average US household. We saw savings at an all-time high. And as we came out of COVID, spending went bananas. And so what we think this is, in part, is a reflection of that. Now that savings is back down and COVID dollars are no longer coming in, and yet we bought all this stuff we bought, people are having a hard time keeping up with the lifestyle that they started to live over the last 2 years. So it could be a combination of all the above, but all the above is not good. You know, any of those issues is not positive. And this has continued to move in a positive direction steadily for the last 2 years. We've been looking at this and watching it and concerned about it, and it continues to move up. We're nowhere near like crazy 08, 09 points yet, but this is still moving in a very negative direction, which has us cautious. One of the things that we've watched just for fun is what's been happening with consumer confidence in the stock market. And finally, consumer confidence is way up. Now, if we were contrarians, we would say that's a sign that we should now maybe pull back our equity position. We aren't, because there is some real, and you'll see this way later in our presentation, but there is some reality to market momentum. And so the fact that investors in general are feeling good about the market isn't a bad thing. But even a quarter ago, we were seeing that consumer confidence in the market was still well below where it was at the bottom of the pandemic. So that was just very interesting to us. It was something we were keeping an eye on. We don't do anything with this. This doesn't really give us any direction. We just find it interesting. And so I like to share it with everybody. But where I want to use this slide for purposes of this today is to talk a little bit about, or a reminder of, what we do when we feel one way or the other about the market. And I introduced this slide at our last meeting. I wanted to bring it back today again because we continue to get a lot of questions about what's going to happen in the market when so-and-so gets elected, or if who and who gets elected, and what do we do? And all this slide is this slide broken down by political affiliation. So again, during the Bush years, Republicans felt a lot better about the market than Democrats. And during the Obama years, Democrats felt better than Republicans. Imagine that. And then during the Trump years, it flipped, and the Biden years, it flipped again. And my point is, in all of this, is while we all care very much about who gets elected, what the potential for policy is, et cetera, et cetera. While we care about it, the market doesn't care. Market does not care who gets elected. Traditionally, and I can show you chart after chart, but the market does not care who gets elected. They don't care which party is in power. They don't care if Congress turns over. The investors as a whole don't care. And why? Because they fall on both sides of the aisle. So as a whole, somebody's going to win and somebody's going to lose, but the market doesn't care. What the market cares about is some certainty. It cares about knowing what to expect out of tax law for the next 4 years. It cares about knowing what to expect out of regulatory action over the next 4 years. But in the grand scheme of things, it just doesn't care about who gets elected. And this makes sense, right? Because investors are investing generally for decades of time. We all will be investing, I hope, for the next 20, 30, 40, 50, 60 years. And whoever wins this election will be there for 4, right? It just doesn't matter long-term who wins and who loses. And I want to drive this home, because what I don't want is any of us making investment decisions based on how we feel about who got elected, because invariably what will happen the second week of November, we will get phone calls from people who say, hey, so-and-so won, the country's going to go to hell in a handbasket, we want out, get us out of the market, this is the end of the world. And I assure them, as I will this time, again, that isn't the case. That the market is going to do what the market does, which invariably is go up. I can't tell you exactly when, I can't tell you how much, can't tell you how fast, but it will go up, because it always goes up. Just doesn't do it in a straight line. And I'll touch again more on that. So don't let the way you feel about the election cause you to take action in your portfolio that could set you behind for decades when you're thinking about a 30 and 40 and 50 year time horizon. And even for those that are on the call that are nearing retirement, you still have a 30 or 40 or 50 year, knock on wood, time horizon in front of you. So don't be worried about the next 4. Be worried about the next 40. All right, I'll get off my soapbox. I'll get back on it again later, but for now, I'll get off the soapbox and move on to another reason why we're a little bit concerned and a little cautious. The unemployment data is still really, really strong. We still sit here today at all-time historic low unemployment. So that is great. We have continued to see wage growth slow, which was intended through the Federal Reserve raising interest rates. It's what they wanted to do by tightening monetary supply or money supply, was to slow down the economy. One of those measures is wage growth. And so we have seen wage growth contract. That's a good thing. Unemployment low. That's a good thing. So why are we concerned? We're concerned for this reason. This data here is starting to look an awful lot like some of these other turning points. And if that's the case, then unemployment is going to start heading in the wrong direction. And if that's the case and wage growth continues to decline, we're going to find ourselves in a good old U.S. recession. Not this year. We don't see any reason why we end up in recession this year, but likely in 2025. Probably the back half of 2025, if I was to guess at it. But we probably find ourselves in recession on the back half of next year. I hope we're wrong on that. We certainly have been in the past. You know, we put a high probability on recession 2 years ago, and it never really happened. The market went down and came back, but we didn't find ourselves in an economic recession. We think in 2025, we're likely to find ourselves there. Now, what do you do with that information? Nothing. There's nothing to do with that particular set of data. We could be wrong, for one, and so there would be no impact. The market can move up and down independent of recession anyway, so it doesn't really matter. And the market tends to move down before we know we're in recession, and by the time we realize we're in one, the market's already on its way back up. It almost always leads us in and leads us back out of recession. So by the time we know that we can do anything with it, it's already too late. The market has already gone down and is typically on its way back up. So this isn't something that that we can necessarily act on. We can be a little bit more cautious in our portfolios, and this is some of the data that we use for that, and we will be. But beyond that, there's not a whole heck of a lot we can do with this data, other than, I suppose, hope we're wrong, because we really don't relish the idea of higher unemployment and recession at all, but we may find ourselves there anyway. And so part of why I share that is just to frame this idea that we're in for slower growth this next couple of years. Don't be surprised by it if we actually end up there. Be surprised if we don't end up there, and that would be a wonderful eventuality if we end up without recession. But if we do end up there, don't be surprised by it. All right, jumping through inflation. I touched on this as I've gone here. Inflation right now is at the long-term average. Since 1926, inflation has averaged 3%. We've been hovering right around that 3% number, 3.1, 3.2, 3.3. And that's not necessarily a bad thing, but it isn't where the Fed wants to see it. The Federal Reserve has targeted 2 to 2.5% in inflation, and we're not there yet. And so the Fed, as a result, as we've been saying for like 6 months now, really doesn't have any incentive to lower interest rates right now. We're not in recession, so we don't have to fight our way out of that with lower interest rates. And CPI, inflation, isn't where the Fed wants it. And so they're really not motivated to lower interest rates. And that's becoming very evident. And as a result of that becoming evident, the market has gone a little bit nuts, because there was some expectation coming into this year that the Fed would lower interest rates 1.5%. It now looks like they might lower interest rates 0.75%. We've been saying for the last probably 6 months that we thought going into this year the Fed would lower rates between 0.5% and 0.75%. If I had to hedge my bet there, I'd hedge it on the 0.5% side now. But the market's now building in 0.75%. As a result, we've seen a bit of volatility, a bit of a pullback over the last few weeks as this has become more and more evident. I have to admit, there's even a chance that they won't lower rates at all this year. And there's a small chance, very small chance, but a chance nonetheless, that the Fed might even raise rates this year, which would cause all sorts of crazy volatility in the market. Not so much that we think it'll be a negative market this year, but just very, very volatile. Combine that with, again, the normal volatility of an election year. This is just going to be a crazy one. So arms and legs inside the ride at all times. Please buckle up. It's going to be a bumpy ride. So just be prepared for it. This is not doomsday. I could be wrong. The Fed might lower interest rates. If they do, we think it's going to be for really two reasons. And we do, by the way, still think the Fed is going to lower interest rates this year. We still feel like there's so much pressure to do so that they will in fact lower them, just not nearly as much as investors have been hoping for the last year. Why do we think they'll lower it? For two reasons. One, to take some of the pressure off of small and mid-sized banks. We've talked a lot about this in the past, but as a quick reminder, 5 years ago, you go into the bank, you deposit your money. They take that money, the bank takes that money, and they reinvest it somewhere. In some banks will put some of that money into real estate lending, right? They'll make mortgages. Some banks, especially small and mid-sized banks, will take that money and they'll go buy 20-year U.S. treasuries, 20-year government bonds. And at that time, 5 years ago, those bonds were paying 2%, 1.5%. Today, those bonds are paying 5%. And so the problem is, if you own a bond at 2% and you need to sell it today, and bonds are currently paying 5%, nobody wants your 2% bond. And the only way you can sell that 2% bond is if you discount the value. And so, and I hope that makes sense. So if I'm going out to sell that 2% bond and everything else is at 5%, if I paid $1,000 for that bond today, I might be redeeming it, or I might be selling it at half off. I might be selling it for $500. And this is the problem with banks right now. So if there was a good old-fashioned run on a small bank right now, and most of their money was in 20-year treasuries from 2 and 3 and 5 years ago, they would have to liquidate those bonds to pay everybody their money coming in asking for it. The problem is it's not worth what it was worth when they bought it, right? So if all those bonds were $10 million, today they're $5 million. There's not enough money there to pay everybody their money. Now, this is not a problem if people just leave their money sitting in the bank. It's no big deal. Over time, the bonds will roll off the conveyor belt. The 20 years will go by. They'll add new bonds. Interest rates will come back down. If time goes by and there's no run on the bank, everything's fine. The only problem is if there is a run on the bank. So that's why FDIC insurance, or the FDIC, came in about a little over a year ago now, saying we're going to back all these banks. No need for concern. Even if your deposit exceeds $250,000, we'll back the banks. And they did that so that there wasn't this mass panic about banking. Now, here's the problem, though. Those small and mid-sized banks still have a ton of pressure on their balance sheet because of these higher interest rates. So if the Fed lowers interest rates, we think they'll do it to take the pressure off of those banks, and they'll justify it by saying we're going to fix the one big inflation problem left in the economy, and that's housing. You can see energy prices have come way down. Core goods come way down. Food at home come way down. Dining and shelter come way down. And when I say down, that doesn't mean prices have gone down. It simply means inflation has slowed significantly. Auto insurance is way up. That will pass. It is not that big a deal. They had to raise premium rates because, frankly, used car prices had gone crazy over the last couple of years, as have new car prices. And with that, auto insurers had to keep up. Replacement values went up, so premiums went up. That will regulate itself as auto prices regulate themselves. But what hasn't regulated itself and won't necessarily is housing. And so we believe the excuse that the Fed is going to use to lower interest rates this year, even though they don't have inflation quite where they want it, is to say that if we lower interest rates, mortgage rates will likely decline as well. If mortgage interest rates decline, inventory will pick up. If inventory picks up, housing increases will slow down. The value of our homes won't be going up as fast. And if that can bring then this inflation number down, then they will solve both problems, right? They'll be able to give the banks what they need to shore up their balance sheets, and they'll be able to bring inflation down by lowering rates a little bit. So we do expect that they're going to do that. But there is a chance they won't. I mean, there is still a slight chance that they won't lower interest rates. All right. So for the last 15 minutes here, I want to talk a little bit about why we're always optimistic. I'm going to skip some of this interest rate stuff because I already touched on it. I want to talk about, there we go, perpetual optimism, right? So I started with cautious optimism and perpetual optimism. And I want to finish with perpetual optimism. So one of the questions we've gotten quite a bit over the last 6 months in particular has been, should I, as an investor, if I have cash on the sideline, put my money into investments right now? And because I don't want to invest, or I'm nervous to invest at all-time highs. I keep turning on the news at night. They keep telling us we're at an all-time high in the market. And do I really want to invest into equities when they're at an all-time high? And so we looked at the data, and what the data shows us, which was a little bit surprising, to be honest, that over the last 35 years, I suppose is that 45 years now? No, 35 years. If we invested at a new high versus investing on any other random day in the market on average, how did we do 3 months, 6 months, 1 year, 2 year, 3 years later? And you can see over 3 months and 6 months, it didn't make much of a difference, which makes sense. Obviously, the market can be so volatile over short periods of time. It doesn't really matter if you invest on any day or at a market high or whatever. But I suppose the takeaway there is it didn't make much of a difference. You weren't penalized or hurt by investing in a market high. And over 1, 2, and 3 years, believe it or not, you were actually rewarded if you invested at a new high. Your investment did better investing on a high day than any other day on average. And that was interesting. A little bit counterintuitive, to be sure. It does speak to the fact that there is real momentum in the market, that as the market is doing better, we feel better about it. Investors continue to then invest, and the market continues to then go up. There is something real to momentum in the market. And that is what we're seeing here. We're seeing that investing at a new high is not dangerous. Now, is it better to invest at a low point? Of course it is. Can you figure out when that low point is going to happen? No. So don't be afraid of the high points, I suppose, is the lesson here. Continue to invest in your 401ks, continue to invest in your investment accounts. If you have cash, don't be afraid to invest it, even at a high. There are things that matter in life. There are things you can control. I talked about this drawing a lot in our last session, where we should spend our time and energy and effort is on the things that we can control that also matter. And the example I used last time was the election. It matters a great deal to most of us who gets elected this year. And and yet we don't really have any control over it beyond the ballot we cast. And what we can control is how we react. We can control how we view things and how patient we are, and we can control our processes, and that's really the stuff that falls on this side. But we want to spend our time focusing on the things that truly matter to us and that we can control. So one of the things I want to talk about in that vein today is patience, and I want to finish with a little bit of our process. So the market is a perpetual process of appreciation, punctuated by significant, yet always temporary, declines. Nick Murray, who's a financial writer, one that we like quite a bit, had this quote, and I thought it was appropriate for this topic. The ability to distinguish between volatility and loss is the first casualty of a bear market. So a bear market is where the market goes down by 20% or more from its highs. And what people do all the time is they confuse that volatility with loss. And there's this other drawing that I like to use for this, because what the market will do, I sometimes talk about the market like it's a live person. I recognize the market is not a live person, but what the market will do is mess with you kind of just for fun. And one of the ways it likes to mess with you is messing with your perception of return. So if I put money in to the market and a year later it's up 15%, it's up 15%, I should feel pretty good about it. And in general, most people will. The long-term average, as I've been saying, is about 10% per year. So if you're up 15%, you're ahead of averages. You're feeling pretty good. You're kind of high-fiving everybody. We had a good year. And yet, if that same thing happens, but in between there's more volatility, it messes with our head. So if we peaked, let's say last month, at 20%, and now we get to the end of the year and we're only up 15%, we open our statements and we say, shoot, we're down 5%. It's the same 15%, folks. Like it didn't change from year to year, point to point. We're still up 15%. In one scenario, I felt great about it. And in the next scenario, I actually feel like I'm down. That's the way the market messes with you. You are never up 20%. And by the way, you're not even up 15%. And if the market was down 20, you're not down 20%. All of that is just happening in the middle. It's all on paper. Nothing happens until you sell. The averages are what the averages are. If the average is 10, the average is 10. Everything that happens in between is volatility. Plus 15, plus 20, minus 10. That's all noise that happens in between the averages. If you're in a well-diversified portfolio that's expected to get something like 7.5 or 8%, everything else that happens away from that 7.5 or 8% is volatility. But we can never confuse volatility with loss. The fact that things have gone down temporarily does not mean you lost anything. And the fact that things went up temporarily does not mean you gained anything. It's all on paper. And it doesn't have an impact until you sell it. And in our world, you're only selling it when you need it for whatever you need it for goals, for income, for whatever it is that you've saved the money for. And that strategy is far more valuable to you. The income strategy is far more valuable to you than anything else. All of the rest of it is just what happens in between the averages. It's noise. And we cannot confuse that noise for return. That isn't the return. The averages are the return. The stock market is a highly efficient mechanism for the transfer of wealth from the impatient to the patient. That is a very famous Buffett quote. We use it a lot. You have to remain patient. If you do, you get your averages. If you don't, your average return stinks because you start making emotional decisions that get in the way. Do not distinguish volatility for loss. All right. This one, and we're wrapping up here over these next couple of minutes. And I apologize for this slide because it's very small print. This is the point at which, if we were live, most of you would be putting on your reading glasses right now. You don't have to read the data because I'm going to talk you through it anyway. But this is a history of bear markets and bull markets, essentially since the end of World War II. The first one happened in 1947. So following the end of World War II, we have seen 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 bear markets. Again, a bear market is where the market falls by more than 20% from its highs. We have seen that happen 14 times since the end of World War II. On some note, one of the times I was doing one of these and somebody said, only 14 times? Yes, only 14 times. 14 times since the end of World War II, which averages out to be about 1 out of every 5 years. It's actually about 5.5, but close enough. I'm going to round down for this one. Happens about 1 out of every 5 years. So about 20% of the time, the market will go down. 80% of the time, it goes up. When it goes down in those bear markets, on average, it goes down by about 32%. And the bear market will last about 11 months. So if you'll permit me, the market will go down 1 out of every 5 years. And when it does, it'll go down about a third. And we'll have to sit there for about a year and wait for it to come back. What does all this mean? Again, as a point of preparation and reminder, I suppose, patience is the key here. 1 out of every 5 years. I just don't know which one. Believe me, I wish I did. If we ever figure it out, I'll let you know. But 1 out of every 5 years, we're going to have to sit and watch the equity portion of our portfolio go down about a third. About 1/3 of that value is just going to evaporate on paper. Poof, it's gone. And then we're going to have to sit there for a year and wait for it to come back. It's like a slow train that we have to watch go by. It's loud. It's obnoxious. We don't like it very much. It's way too slow. It just takes time. But it will come back because it's always come back. And this time will be no different. Whenever the next time is, that time won't be any different. And the reason we have to sit through it and watch that slow train go by is that 80% of the time the market's up. And so if I want to capture all that up, I have to be willing to patiently sit through all that down. Patience. Patience is what gets you the long-term returns. Patience is how you get the 10% averages. Patience is why after 10 years, and any 10-year rolling period, the market is up 97.4% of the time. And the other 2.6, by the way, on average, it's only down 1%. So with time comes low volatility. Without time, we have high volatility, right? In any given day, it's a flip of a coin. Market could be up, market could be down. 53% of the time it's up, 47% of the time it's down. It's a flip of a coin. Crazy volatility in any one day. But the further out we go, the less volatility we see, right? In any 1 year, the market can go nuts. Up 52, down 37 over the last 20 years. 5-year rolling periods, it gets pretty good. 29 up, 2 down. 10 years, 20 up and 1 down. 20 years, no negative returns in there at all. With time comes less volatility. With patience comes less volatility. And yes, even if you're retiring or in retirement, you still have 5 and 10 and 20 and 30 and 40 years ahead of you to remain patient. And I say it that way because I think people are sometimes disappointed to hear that if you're in your 60s, and you have a 30-plus-year time horizon, you're probably going to have to sit through 6 more downturns in the market on average, right? If we just have average markets, you got 6 more bear markets to sit through in your lifetime, even through retirement. And again, all of this is to simply have you mentally prepared for when they happen. They don't last forever. This time won't be different. This will not be the end of the world. We just have to sit patiently and wait for the train to go by. One of the ways that we help mitigate that volatility as best we can is through the process that we follow. So in the past, I've talked a lot about asset allocation and how we broadly diversify your portfolio so that you don't feel all of it, right? You have a more consistent return over time. One of the other things we do is monitor your managers for top decile returns. And so as an example, large cap growth stocks or funds that we might build into a portfolio, we are on a quarterly basis screening those managers to make sure they're staying in the top decile, the top 10% of all other managers. You can see it's a big difference between a top manager and a bottom manager over a 20-year time frame. You want the top managers. And so we are screening on a quarterly basis for this. And what that actually means is in a lot of cases, you will see in your portfolios index funds. We're going to have a lot of index funds in there. Why do we have index funds in there? Because generally speaking, most active managers, not all, but most active managers can't keep pace with indexes, with the index that they manage against. And so index funds are very inexpensive. They're broad-based. They allow us to capture what the market gives us. And in a lot of cases, they are in the top 10% of all like funds. And so you will see a lot of indexes or index funds in your portfolio. You will also see a lot of active management, particularly right now in the bond space, where interest rate movements have giant impacts on what's going on in bonds. So we're trying to keep duration short. One of the ways we can do that is by having active managers in the bond space. And so here you see a lot of active managers right now. Over time, that could become index managers again. So we are, as a part of our process to try to manage volatility in our clients' portfolios, doing the work to diversify and try to do our best to find top managers wherever possible. And we will continue to do that to try to mitigate some of the volatility. But in all of this, and I've promised that I will always finish with this chart, and I continue to do so. You will notice the market always goes up, right? It just doesn't go up always, if that makes sense. It doesn't go up in a straight line. If you happen to read our newsletter from the last quarter, you'll note that since the bottom of the market in 2020 through today, the market's up 125%. And all you had to do to get that was be patient. You had to stare out the window for the last 4 years and let it happen. The market goes up. And despite what news media will have you believe and the panic that it will try to cause, over time, it goes in a positive direction. It just doesn't do it every single year, and certainly not every single day. So remain patient, be ready. This is a very long way of me saying, be ready. Be ready for the volatility that's likely this year. Be ready for the volatility that's likely as we head into next year, as we start to see some more recessionary data, we think. Be ready for that volatility, but don't act on it. If I could go back 5 slides here quickly, right? There are things we can control, and there are things that matter. And all you can control about the market is how you react to it. And so I'm going to ask you not to react to it. Go about your life, enjoy your day, know that 97% of the time the market's going to be up over 10 years, but be prepared for the negative press that comes along. With that, I want to thank you. I appreciate the time. I hope it's a good use of an hour of your quarter, like I started with. If we can help you with anything, please reach out to me. Please reach out to one of our advisors. We're happy to help. If there's anyone in your life that we can help, our only qualification is that you refer them to us. We need no more qualification than that. If you think we can help someone in your life, we would love the opportunity to do that, and we would appreciate the recommendation. But beyond that, if there's anything we can help you with, please don't hesitate to reach out, email, phone call, whatever's best. But otherwise, I look forward to seeing everybody here next quarter, and we'll see where it takes us. Appreciate the time. Enjoy your day, and we'll talk to you again real soon.